Hello, savvy investors, and welcome back to the Dividend Uncle. Following the footsteps of last month's journey through the realm of REITs, where I shared the 3 to buy and 2 to dodge from my own portfolio, this month, we're delving into dividend stocks. True to the mission of the Dividend Uncle channel, I'm revealing the next set of moves in my real investment journey, 3 dividend stocks I'm personally adding to my portfolio in March 2024, and 2 I'm steering clear of for now. It's all about navigating the investing world with transparency and sharing actionable insights to help you to make your own decisions. Before we start, your likes, subscriptions, and comments are what drive this channel forward, allowing us to share valuable content tailored just for you. So, show some love by liking this video, hitting subscribe, and sharing your thoughts in the comments. Okay, let's dive into which dividend stocks are making the cut for me this month and which ones aren't. Direct from the Dividend Uncle's playbook. ST Engineering, a sky-high performer. Leading the Dividend Uncle's must-buy list is ST Engineering. This powerhouse has recently announced a spectacular leap in earnings, up 19.9% year-on-year, with new contracts signed in 2023 amounting to a whopping $14.8 billion. This performance not only highlights ST Engineering's robust growth but also secures its future with an order book standing at $27.4 billion, ready to deliver approximately $7.9 billion of this in 2024 alone. In the aviation arena, the commercial aerospace division is flying higher than ever, with a 9% growth in just the last quarter of 2023 in annual revenues that have eclipsed pre-pandemic figures at 3.9 billion Singapore dollars. The surge in Asia's aviation recovery and a growing demand for aircraft maintenance and repairs are propelling ST Engineering into a favorable future, with optimistic revenue and margin forecasts on the horizon. Not to be outdone, the defense and public security segment is also expanding its global footprint. In 2023, it secured international defense contracts worth 950 million Singapore dollars, with significant opportunities in emerging and critical markets like the Middle East and Eastern Europe. The backdrop of global geopolitical tensions presents a fertile ground for growth in defense, promising a strong order book fueled by the group's expertise in cyber, naval, and munitions solutions. Coupled with a generous dividend yield of 4.1%, ST Engineering stands out as a prime candidate for my dividends portfolio. It's the blend of immediate success and long-term potential that makes ST Engineering a compelling pick for any investor looking for stability and growth. QAF, the staple dividend stock. The second dividend stocks I'm buying in March is QAF, better known as the powerhouse behind Gardenia, the leading bread brand that's a staple in households across Singapore, Malaysia and the region. Now, the business of baking bread might not sound as glamorous as tech or high finance, but therein lies its charm. Investing in the staple food sector offers a stability that's hard to find elsewhere, making QAF a long-time core component of my dividend stocks portfolio. This past year, QAF has proven why it deserves a spot in the Dividend Uncle's portfolio. Net profit surged a remarkable 101% in the second half of 2023, driven by robust sales growth in its bakery segment across all core markets. Even more impressive, the company has maintained a consistent dividend, even across the COVID years. A dividend yield of 6% definitely meets what I crave in a dividend stock investment. While the company faces the universal challenge of rising costs, from labor to raw materials, their focus on efficiency and strategic product mix adjustments have kept them on a path of sustainable growth. Genting Singapore, a high-reward bet with caution. Sliding into my portfolio is Genting Singapore, marking its spot with an impressive 80% leap in net profit for 2023. Amidst a 40% revenue growth reaching $2.4 billion, the company steadfastly maintains a final dividend of 2 cents per share. The cherry on top? A dividend yield standing at an attractive 3.9%, making it a luring pick for income-focused investors. Beyond the numbers, Genting Singapore is investing heavily in its crown jewel, Resorts World Sentosa, or RWS. With the Forum Lifestyle Zone and Universal Studios Singapore's Minion Land eyeing early 2025 for their debut, and a waterfront development that promises 700 new hotel rooms by the second quarter of 2024, the future looks bright for RWS. These expansions are strategic plays aimed at capturing the rebound in global tourism, especially with Singapore poised to welcome the world back. However, it's not all smooth sailing. Genting's share price has witnessed a rollercoaster ride, dropping by as much as 30% from the recent peak, highlighting its vulnerability to global travel disruptions. This volatility serves as a reminder of the inherent risks in this segment of the tourism sector. So, while I'm drawn to Genting Singapore for the potential tourism recovery upside and its juicy dividend yield, I'm threading cautiously. It'll occupy a smaller slice of my portfolio pie, balancing the quest for growth with my overarching goal for portfolio stability. SBS Transit, a bumpy road ahead. As we explore stocks with a cautious lens, SBS Transit comes under scrutiny. The company's recent financials show a slight improvement, with 2023 earnings up by 1.5% to $69.1 million and a commendable effort to boost ridership and advertising revenue. Nonetheless, an underlying concern overshadows these gains. Despite Singapore's return to normalcy, SBS Transit faces a unique challenge that many other businesses don't: changing commuter habits. The shift towards remote work, solidified over the past years, means fewer daily commuters, directly impacting SBS Transit's core bus and rail services. This trend raises doubts about the company's ability to match, let alone surpass, its pre-COVID ridership and revenue figures. Further complicating the picture are the escalating operating costs, from electricity to manpower, in an environment where increasing prices to offset these costs is often met with resistance. With the impending expiry of the Jurong West bus package and the anticipated drop in bus operation revenue, SBS Transit's path to growth appears fraught with obstacles. The dividend yield of 4.25%, while attractive, does little to alleviate concerns about the company's long-term performance in a post-pandemic world. While I admire the sector's resilience and the company's commitment to service excellence, these structural challenges place SBS Transit on my avoid list for now, as it does not align with the stable growth and resilience I seek for my dividend-focused portfolio. DFI Retail Group, encouraging turnaround, but what's next? Lastly, DFI Retail Group finds its way onto my negative radar. The transition from a loss to posting earnings of $32 million for 2023 initially sparks interest, especially when paired with the announcement of a final dividend of 8 US cents, a leap from the prior 3 US cents. This financial rebound suggests a ray of hope for DFI, a glimpse of stability after a stormy period. However, my optimism is tempered by the shifting tides in consumer behavior, particularly in DFI's stronghold, Hong Kong. A growing trend sees local consumers increasingly crossing into Shenzhen, China, for their shopping needs, lured by the variety or perhaps the pricing. This emerging habit poses a significant challenge for DFI. In addition, significant challenges loom large for DFI's China venture, Yonghui. For me, its performance from year to year seems to present a puzzle wrapped in a mystery. These factors could influence DFI's future performance and its ability to maintain the recovery trajectory. Given this backdrop of cautious optimism tinged with apprehension, DFI Retail Group secures a spot on my watch closely list. For now, I'll hold off on embracing DFI wholeheartedly, opting instead to monitor how the recovery plays out and their long-term impact on the company's outlook. Conclusion. So, there you have it, 3 promising picks for growth and dividends, and 2 that pose more risk than reward in the current climate. As always, I encourage you to do your own research and consider your investment goals before making any decisions. Investing wisely means looking beyond the surface to understand the risks and opportunities each company presents. Thanks for joining me on this financial journey, dissecting the dividend stocks to buy and which to avoid for March 2024. If you found this analysis helpful, don't forget to like, subscribe, and hit the notification bell for more investment insights from the Dividend Uncle. Until next time, stay savvy, and keep investing smart.